Hey everybody, good day to you. Glad to be here with you on this Friday. Time for Advanced Option Strategies. My name is Brent Moores, and last time I was with you, which was a couple weeks ago, because I was actually out of the office last week. But a couple weeks ago, we talked about diagonal spreads, and this week I want to revisit the topic, but with a little twist here. I want to talk about them in a way that was very helpful to me as I was learning diagonal spread. So I'm hoping it's helpful to you. Can't guarantee it'll be, but I think it will be if you think about them this way. In fact, we'll hit that up in just a minute. I'm joined alongside Mr. James Boyd in the chat helping me out here. So as you have questions, feel free to type those questions in. And between James and myself, we'll do our best to get to those. Also, follow us on X, formerly known as Twitter, at Brent Moore CS, at James Boyd CS. And let's just hit up a few disclosures here real quick before we get into the meat of it here. Options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only, should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. We'll look at actual trades today, but keep in mind they are not recommendations. The paper money application is for educational purposes only. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including loss of principal. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And let's see, stop loss orders don't guarantee an execution at that price. So just be aware of that. In the chat, I have put in a link to the playlist for this class. And the reason is, if you are interested in diagonal spreads, the more traditional way I've taught them, then you could check out that session from 2 weeks ago. Today I want to start though. I want to do this by comparing a diagonal spread and a covered call, because I think a lot of you are familiar with covered calls, perhaps comfortable with covered calls. And so let's start out that way. And I just want to take as an example stock, and with a lot of you, I think a lot of you are familiar with covered calls. We'd call a covered call more of a neutral to maybe slightly bullish type strategy. So I'm going to use Microsoft. I'm going to kind of use some more prominent names here today, companies that you're familiar with. All these stocks I think I have here are on the S&P 100. They all have relatively liquid options, although we're going to check that on a case-by-case basis. But if I'm considering a covered call on Microsoft, it's kind of an expensive stock, right? $414 stock. I'll do a little rounding here as we do this. And so if I have a $414 stock, 100 shares of that is going to cost me around $41,000. Okay. Again, I'll round a little bit there. So that's a pretty big chunk for 100 shares of stock. And if I'm going to do a covered call on that, well, let's look at it and see how it would turn out. I'll go out, say 28 days on that. Let's do 28 days on that. And I'm going to go out and sell. We'll go out to, say, about a 28 delta here on this. So it's going to be out of the money, more than likely, just probability, more than likely it will expire out of the money. You never know. The delta kind of implies that there may be roughly a 28% chance that it expires in the money, but has decent time decay. There's our theta on that. And if I were to sell this just at the bid price, we're looking at $385 for that option, okay? So if I do 385, let me put in $385 there. And if I were just to take, let's just do a little formula here. I'm gonna just take the short call, and I'm going to divide that by the stock price to give us just a percentage of one versus the other. So just under 1% return on that. Okay, that's for roughly a month's worth of time. So, 1% annual doesn't sound like much. 1% over a month, maybe not as bad in that from that perspective. But there's pros and cons, and one of the cons is that's a lot of stock for a lot of people here. One of the pros of doing it on a stock is if there's a dividend that's paid, you get to collect the dividend. Even if you have a short call on it, you get to collect that dividend. And the stock, you'd only do this if the stock, you're bullish longer term, and there's no expiration date on a stock. But because of that, because of the whole, just the sheer cost of it, if we look at this and we say, look, that's a little bit more than what I want, that $41,000. What if instead of doing that long stock, what if instead I do a long option, a long call option in its place? Because what I do, my goal is to kind of collect that $385, take advantage of the time decay on that. But I don't want to do just that short call. I don't want to just do a naked call. There's a lot of risk to that naked call, right? Theoretical unlimited risk on that naked call. So what if instead we do a long option as a substitute for that stock? Now, can you do a leap? Yes, that's what Charles said in the chat there. You could do a leap if you wanted to on that. We can go out and do that as a substitute. Well, let's look at some examples here on this, and just to go. So for this example, I'm not going to go all the way out to do a leap. Well, actually, I will. I'm going to go out quite a ways. Let's go out, because you can go out. I'm going to go out more than, if I'm selling 28 days, I'm going to go out longer in time here, 35 days, 42 days. Let's go out to 182 days. Now, we can go even farther than that. We can go out years. Look, January of 2027, that's a long ways. And if you look at that, you may go, well, these are going to be really expensive. They are going to be pretty expensive. But keep in mind this, as I do this, and I'm just going to look at 182 days right now, but you can go longer. And I'm going to go in the money. I'm going to go to like a 70 delta here on this. And we're going to look at this and we're going to say, oh, look, that's like $4,800. I'll round just a little bit there for the option. Now, that's an expensive option. Let me put that down, $4,800 for that option. My short option is going to be the same here. So I'm going to buy the longer term, more in the money option. I'm going to sell one that I would consider like a covered call on normally. And do you see the percentage difference there in terms of what we're looking at, in terms of how much premium we're bringing in compared to the initial cost? Not only is that initial cost roughly 10% of what the cost would be for the stock. So we may say, that's an expensive option, Brent. Yeah, you may say that. That's true. But the reality is that's a lot cheaper than the stock. Now, it's not the stock. It's not an exact substitute of the stock. So sometimes people will call this a poor man's covered call. Okay? It's not technically a covered call, though, because we don't own the underlying stock. We're not entitled to dividends, and this long option is going to expire. In this case, it's going to expire in 182 days, I think, is what we came up with. But look at the percentage return there that we're talking about. This short option is going to expire in roughly a month. And then, assuming things are going well, could we turn around and look and consider doing it again in the future? Yeah, we can consider doing that again. Again, 8% may not sound like that great, but we're talking about a month here in terms of that. Now, the challenge is you can't just focus on the 8%, because the stock could drop. This stock could drop substantially, and we could lose a lot of money here. Let's consider the delta on these, okay? What's my delta on the stock? Well, delta on stock is going to be 100. 100 shares of stock, delta is 100. My delta on my short call was, I think, 28. So that's going to be a negative 28 delta there. So in this case, let's see, that'd be about a 72 net delta. And delta can change over time. It can also change as the stock moves. 72 net delta on that covered call there. If I go for this diagonal spread that we're talking about over here, well, instead of the 100 delta, we had about a 70 delta is what we were looking for. Again, the short option has about a 28 delta. And so that gives me roughly a 42 net delta. 42 net delta. Okay. So comparing these two, one of the differences is, there's a bunch of differences, and I'm going to try and illustrate these differences, both pros and cons. But one of the differences is your delta is reduced quite a bit. And is that good or bad? Well, it's not good or bad. If things are going well and the stock's going up, then I'd rather have the higher delta. If the stock's going down, I'd rather have the lower delta, to be honest. You just don't know ahead of time. So there's pros and cons. But this trade just moves from a delta perspective a little bit slower there. But from the standpoint of an initial investment, it's a lot cheaper here. So that's a diagonal spread. Okay, that's a different way of viewing a diagonal spread. Consider it kind of like a covered call in that regard. Okay. Now, George said you could buy 2 long calls, 170 delta, and yeah, you can look. I'm not trying to prescribe to you exactly how to do this. What are some things we could change? We could change the expiration date. Okay, we can go out farther. What's going to happen? What's going to be the consequence if we go out we buy more time here on the long call? Let's just kind of assume for a sec we're going to stay with this roughly 30 days till expiration on the long call. Well, on the short call, excuse me. On the long call, what if we go out farther? What if we go 308 days instead? Well, if I'm going to do the same strike price, what strike price did we have? We had the 390 strike price. If I do that same strike price, it's going to cost me more. It's more expensive. Now, you may go, well, wow, that's an expensive option. Well, again, consider it compared to buying the stock. A lot cheaper, right? It's a more leveraged move, though. Okay. Whenever you're doing the option, when you're comparing the option to the stock, it's more leveraged. Now, that doesn't mean that there's more total risk on the option. The option can go to zero a lot quicker, a lot easier than the stock can go to zero. But if the stock goes down 10%, our option may be practically nothing at that point. From a percentage standpoint, that long option could go down to zero a lot quicker. But consider the total risk. Okay? What's the total risk on this covered call here? Well, roughly $41,000 if the stock went to zero, which, albeit is very unlikely, but theoretically we have roughly $41,000 in risk on this. What's the risk on this one? Well, roughly $4,500 in risk on this. But but it can get there a lot easier. Okay? But make sure you distinguish the difference between the total risk and the leverage on that. All right? Any questions so far on this? Okay. So, because we can do little variations on this, we can buy more time, which makes it a little bit more a little closer to the stock. Again, it's still not the stock, but the expiration date doesn't bump up against us as quickly. It's more expensive. It's a little less leveraged. So that's certainly one. You can adjust the number of contracts that I think George mentioned that in the chat. You can adjust the number of contracts. But let's do that. So this is a diagonal spread. Now I'm going to do the original version I just did with the 182 days. And so we went out 28 days here, and I went to roughly a 30 delta. Okay. Typically, on covered calls, again, this isn't a covered call, but typically on covered calls, I would say traders often look for deltas on the short option, maybe roughly in the 30 range, maybe 20 to 40, somewhere in the 20 to 40 range. We'll kind of split the difference and go to there. I'm going to sell that contract. I'm going to go here. I'm going to go out. Again, I'll stick with that 182. And on this, I don't have to go to the 70 delta. My example is a 78 delta. The higher the delta, the closer it is to move more like the stock. The lower the delta is, the cheaper the initial cost would be. I'm going to hold down my control key. I'm going to click on that. And I'm going to right click right here on this. And I'm going to analyze this trade. And let me get rid of any other trades on here. Okay. Just move this down a little bit. Here we go. This is what the delta looks like here. This is what the risk profile looks like on this trade. Looks a lot like those diagonal spreads we did a couple weeks ago. Okay, right? Not that different on that. But what you can see is you can see where the risk is, and you can see where it goes down, and you can see the time decay. Right now, it's positive theta if the stock stays kind of up in this range here on that. So there's that. I can also see what my Greeks are on this. Positive theta, time decay is helping us out, and you can see it's a bullish trade, right? It's a bullish trade on there. Let's go ahead and send that trade. How about? I'm going to confirm and send. And I'm going to put that in our options trades. I'll send that. And then how are we going to manage it? Well, if I go here and I'm looking at Microsoft and I'm looking to manage, then what I'm going to do is I'm going to consider the short call, which is right here. And hey, look, as we get near expiration, we may consider rolling out that short call. Fair enough? We'll consider rolling out that short call to where we can sell another one, pick up more time decay to help us out. This is a bullish trade, though. If we turn south on Microsoft, let's say Microsoft starts to break through some support levels. Let's say I'm gonna call this a support level right here. Okay. Let's say Microsoft breaks down below this $400 level. We may consider just exiting the whole thing. Okay, we'll almost assuredly be in a losing position in that case. So I'm not going to lose track of the technicals, but that would be a principal way of managing it. If things are going well, I'll look to continue to roll out the short option as time expires. If things are kind of going sideways, that's fine. Our time decay is helping us out. If things go south, and when I say south, we'll probably pick a exit point here on this and say, look, if we break down below $400, I'm going to get out of this trade. You can always do that. You can go to your trade here. It hasn't filled. Let me just see if I can get this to fill here. I'm going to move this over and let's get this filled. Okay. Okay. We just filled that order. Now, if I say, look, I want to, it's not a working order. I'm going to go to what happened to Microsoft? Okay. Here's Microsoft. And I'm going to create a closing order on this. And I'm going to put an exit order on this. So this is my exit order to get out, but we said we're going to get out if we break below $400. Go to the trade tab. I'm going to make this a market order, good till canceled. Go to my gear. Click on that gear. And we're going to say if Microsoft marks less than or equal to, we'll say $400. We're going to cut bait, so to speak, and get out of that. Okay. Okay. So Trader Jane said in the chat, why not buy deep out of the money long dated trade and do the same? Okay. You can. But it becomes less and less like a covered call if you do that. Remember, if I do the in the money option with that 70 delta is what I did. It doesn't have to be exactly that. But if I do that in the money option with that 70 delta, so let's say we do that May 600 is what Trader Jane is proposing, okay? Well, let's see what we got. Let's go to my May contracts. Let's go to that 600 strike. And can we buy this? Yeah, we could buy this. In this case, what's our net delta going to be on that? We're changing the character of the trade. I'm not saying it's good or bad, but instead of a bullish trade, I've just turned this into a bearish trade, right? If I do that. If we go way out of the money like that, I've turned that into a bearish trade. My net delta is going to be a negative, 20, almost 30 delta on that. So play with it, but just make sure you realize what your forecast is. Are you bullish or are you bearish on that? Now let's look at another example. And again, for my other example, I'm going to use technical analysis here. So I'm going to pull up Apple. Apple's been kind of going sideways, okay? Apple's been kind of going sideways, which is kind of what we're looking for. Remember, if we were just doing a covered call, let's say you were doing a buy right covered call. You're buying the stock, you're selling an option, you're selling the call option. What's your forecast? Well, it's certainly not bearish. It's not super bullish, because if it's super bullish, then it makes no sense to add the short call on and cap your gains. But if you're kind of neutral, a little bit bullish, then a covered call makes sense. And this variation of a diagonal spread may make sense in that case too. So in this case, what's my take? Well, here's a technical analysis take on this. And it doesn't mean that, look, I don't know exactly what Apple's going to do in the future, but I'd say in general, we've had kind of a general uptrend, but more lately, we've been a little bit more sideways, haven't we? Okay. So with that in mind, I'm going to do a similar thing here. And maybe we'll tweak it a little bit. Apple's a little bit of a cheaper stock, $224. So let's do this. Let's pull up Apple here. And I'll do this. I'll scroll down here. I'm going to say Apple was $224. So that's about $22,400 for the stock. Short call, I'm going to do something similar, but you don't have to go out a month on that. You can go something shorter term if you want. Let's take a look. Let's go to Apple. Instead of going out a full month, maybe we'll go 14 days. Is that possible? Now, if I'm going out 14 days, I'm probably going to have to go a little closer to the current strike price to get much in the way of a premium. But let's see what we got here. I'll go out 14 days, 230. I'm going to do that 230 call. Well, let's just look on the graph and make sure this checks out. Is that too close? If I do a strike right there? If it is, then maybe I go out higher. We can go to 235. The challenge is with the 235, let's just look and see that 235, because that's giving us 42 cents. That's not much there. Okay. I probably would have to go out to a longer time frame. I'm going to do that 230. $132. Okay. 132. Percentage wise, what does that give us? It's short term. This is only a 2-week trade here. About 0.6%. About 0.6% on that. Again, we'll look at that same option, only out 2 weeks in this case, $132. But let's do a different one. Let's go out and I'm going to go out further. I'm going to go a full year on this. Well, let's go out. Let me do that. Let's go to December. I'm going to go all the way out to like, this is like the end of next year. So this is a longer term bullish play on Apple. Along the way, we'll look to roll Apple. But what I'm going to do here is I'm going to go and it's going to be a more expensive option again. But let's go out and I'll go 65 delta maybe. And it's going to cost us about $30.45. So $3,045. $3,045 for the option. What's our return on that? Okay. So again, big difference in terms of our 2-week return on the stock doing traditional covered call versus doing this diagonal spread, about 4.3% return 2 weeks. If it works out perfectly. And if it works, think about this. If the stock goes sideways during that time, now it's probably not going to go exactly sideways, but if it stays out of the money on the short option, that's going to expire worthless. We get to keep that money on that if it expires worthless. Now remember, short options can be assigned early. So don't forget that. But if this expires worthless, and if this long option stays roughly where it's at, then that money is ours. Money is ours to keep. And then we can look to roll out again. We don't need to roll out another 2 weeks. We can roll out a month. We can roll out 2 months, however we want to. We'll just reevaluate it at that point there. So that's how we could do that. So let's look at this. And we said we are going to buy, I think we said what did we say? That's 65 delta. I'm going to click on that. We were going to sell just a couple weeks out of time, just a couple weeks out. And I was going to sell the 230. Hold down my control key, click on that. And there we go. Net cost about $2,900. Let's analyze this trade. Let me just make sure I don't have anything else in there. Nope, that looks like it. Oop, hold on. There we go. And that's what our shorter term 2-week graph looks like here in terms of our diagonal spread. Break evens around 223 short term and 247. 223 is a rough, let me mark that on the chart for you. 223, so we're bullish on this, and 247. Short term, that's where we want it to be, right in that range. All right, let me just move this drawing tool off my chart, move that out of the way. And let's go back to our trade and move that up, see if we can get filled on that. Send and send. It's thinking. It's thinking. We'll let that cook there a little bit there. All right. Okay. So Mighty Mouse mentioned in the chat, what's our margin requirement on this? Yeah, there's a margin requirement. Maybe it's something I should have mentioned. Let me do this. before this fills, let's go to that working order. I'm going to click on this. I'm going to cancel and replace this order. And let me confirm and send and just see what it's saying for. Let's see. Max loss. Let's see. Max loss is it's not going to give us the max loss here. Cost of trade $2,900. And look, this is in the money. It's an in the money option. The long option is in the money. And where's the risk on it? Think of it this way. It just filled. Okay, it just filled. The risk on it is if the stock goes down, okay, how much can we lose on this? Well, the short option, if the stock goes down, it just goes worthless. So that's not the problem. The long option is where the risk is, because that's the one that's in the money, and the max theoretical loss on this is my initial debit on that trade. Okay? On diagonal spreads, your max theoretical loss on these is the debit that you have on the trade. So in addition to that cost, there's no additional margin requirement. What about a covered call? Well, same deal. On a covered call, the only difference is there's more money out of pocket up front. I mean, when I say the only difference is, that's obviously there's a difference between the trades, expiration, dividends, stuff like that. But in terms of the initial cost, there's a big difference in the initial cost of that trade. Okay, is that making sense there, everybody? Questions? Let me know your questions here at this point. George says he likes to sell less than 20 deltas on 30 days to expiration to pay for the time decay. So just in terms of kind of typical approaches on this, I would say very typically the short option, we're going maybe 30-ish delta out, maybe 30-ish days till expiration. Long option, in the money typically, 50 or more deltas, and out beyond 50 days till expiration, doing diagonals the approach that we're doing right now. That's a little different than the diagonals that we did a couple of weeks ago. So if you want, double check that class. Okay. All right. Let's now I want to move to some money management here, unless you have any questions on the diagonal spread that we're doing. That we can always track these as we get closer to expiration on these. We're going to keep an eye on them. And I just need to move, hold on, Microsoft, let me go and move this to, let's move this to our options group, Apple to our options group. There we go. Okay, let's go. Now we did a diagonal spread last week, okay? And on Bank of America. Okay. Let's hit a couple questions here though. Okay. All right. Thank you very much. So where do I get paid on these types of trades? Okay. All right. So what's our goal on this? Well, let's do this. Let me go to, we'll go to Apple. We'll go to the one we just did. So let me go to the Analyze tab. Let me pull up Apple here. So we are paying upfront for this trade. There's a debit upfront that cost us. Time decay should help us out. If you look at this, you see the purple line here. I'll put a little dash there. If our stock kind of stays in this zone, as we get close to expiration, we make it becomes more and more profitable. Okay? In theory, if at the end of the expiration of our first option, okay, our short option, if things go well, we should be able to sell the contracts for more than we bought them for. That's the goal, okay? To sell them for more than we bought them for. But let's say the stock doesn't go anywhere, okay? The stock right now is right around in this range right here, okay? Stock right there stays right there. What are we going to do in a couple weeks when this first one expires? Then we'll we'll consider selling another contract. Okay, we'll sell another short contract, which will increase the time decay on that. Okay, it will increase the time decay on it, and that'll help. Now, at some point, we may decide not to roll it out. And if we didn't roll out the short option, we would just be left with a long call. Okay. And a long call, we just want the stock to go up, and that's an outright bullish trade there. Keep in mind, on this trade, it is delta positive, so we want that stock to go up. Okay. Now, what's the expected loss? To another question. Well, the expected loss is it depends what the stock does. If the stock stays kind of within this range here, you can model out what the loss would potentially be. Hopefully we stay in a profitable zone. How much could the loss be? Well, the loss could be as much as that initial debit there on that trade. Okay. So your max loss is going to be that initial debit. All right, let me go back out here to let's look at Bank of America. So I'm going to go to BAC. Here's Bank of America. This is a diagonal spread. Looks kind of similar, this profit loss, to the trades we did today. But in this case, what are our expirations? Notice the expiration here. We have, let's see, December 6th and November 22nd. Different character than the trades that we did today. Okay? And that's fine. Strikes, 41, 43, call. Our short option is expiring in 7 days. So we may want to do something with this in 7 days. Right now, our current our current price is right here. So here's current price right there. Here's kind of break even on the downside. There's no break even on the upside. We don't care how high it goes. That's just the way we constructed the trade a couple weeks ago. We constructed it in mind so that we'd only lose on one side of the trade. So if this goes down to 40, below $41, that's definitely not where we want to go. Right now we're at 46, so that's, so we're in pretty good shape here on this. But we only have 7 days to expiration. So the question then becomes, how much do we have left to make on this trade just from the time decay standpoint here? From there, it doesn't look like there's much right now on this. So let's go to this and let's look at our short option here. Current price is 355. Remember, short options can be assigned early, and this is in the money right now. This is in the money. So we're not going to want to wait for this to get too close to expiration here on this. We certainly could make more money on this if this were to go up, but I don't want to risk early assignment. We've made $82 on this. I think we're going to take that as a win, and we'll look to just get out of this trade. So I'm going to right click. You can tell right here, I have this buy sell. I already have an exit order in place on this. I'm going to right click on this. You can either cancel it entirely and just do a new sell, or you can just change this and to one that's already where it's already filled. So look, if it's less than $50, we're going to get out of this trade. Save, confirm and send. Okay? All right. So we're out of that trade. We booked a little bit of a profit on that sample trade that we had. Okay. George said, this is similar to covered call. In the short term, you cap your upside. Absolutely. That's why if you're debating this, if you're debating a diagonal, it's kind of this, it's similar to a vertical spread, a long call vertical. Remember, on a long call vertical, if you have a long call, let's say you have a long call. If you do a long call vertical and you sell a call, you're capping the upside. If you don't want to cap that upside, you can just leave that long call on there. And if the higher the stock goes, the better it is. In the case of a long call vertical, we're capping the upside, but we're also reducing the cost of it. A diagonal spread is like a long call vertical in a lot of ways. We have a short call. We have a long call. That's what we just did, a short call and a long call. The difference is this. We just separate the expiration dates on those. But the principle is the same. We're still capping our risk on that. We're capping our reward too on it as well. So they're very, so a diagonal is kind of, anyway, that's what we did on this. But if you don't want to cap your upside, you could just do a long call on that. And there's, the long call though is a positive, the long call is a negative theta trade though. Time decay is going to hurt you out on that. Okay. So there we go. Let me just see. Darts Player said, is there an instruction webinar on how to use option groups and group trades together after the adjustment to keep the correct total P&L on the risk graph and not lose it after a roll? Darts Player, that's a good question. So one of the challenges on the Thinkorswim platform as you're using it is, once you roll out a contract, once you roll a contract, the PL open is just the PL open, and that the old contract that you got out of. Because remember, a roll is you're getting out of the old contract and you're getting in new contracts. Okay? And so if we're in the new contract, it doesn't consider the old contracts anymore. So I think that's the basis of the question. And the answer is no, I don't have any solution for or video on that there, Darts Player. It's a great question, though. I wish I had something for you on that, but I just don't. So there's different ways to do diagonal spreads. There's what we'd call more in the money diagonals or out of the money diagonals. Today we demonstrated more out of the money diagonals. The Microsoft and Apple trades were more out of the money diagonals. That's what people kind of colloquially call a poor man's covered call. And I tried to compare the attributes of the two and to kind of show you, to compare the traditional covered call with this diagonal spread in this kind of vein, the same type approach to that, as a way of trying to increase your potential percentage returns on that. But just realize there's the downside, there's the higher leverage, and if it goes against you, percentage-wise, you may see a quicker loss more quickly on that. So that's what we're calling a poor man's covered call. It's a diagonal spread. A little different approach than the diagonals we did a couple weeks ago, but I thought it's something you should be familiar with. So I want to thank James in the chat for helping me out. I want to thank you guys all for joining me today. Remember to subscribe. If you look in the bottom right portion of your YouTube video, should have a subscribe button if you haven't subscribed already. Now, you don't need to click on the subscribe if you've already subscribed. You may unsubscribe. Coming up next, we have ThinkScript studies. So I think Ben may be teaching that one today. I think Mike is out. But there you go. So what I would encourage you to do, though, is practice. Practice these. Maybe you love them. Maybe they're part of your portfolio. Maybe they're not. Maybe they're not something you're interested in. But do some paper trades. That's why we have the Paper Money platform there for you. All right, everybody. Have a wonderful weekend ahead. And we'll see you same time next week. Bye-bye.